This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more. How is commercial real estate going to perform in 2026? Which two asset classes are actually performing pretty well, maybe even outperforming other sectors of commercial real estate that might surprise you? All that and more on today's episode of Office Hours. Welcome back to the Commercial Real Estate Investor Podcast. My name is Tyler Cobble. I'm your host. And on Office Hours, we dive into your questions. We dive into my thoughts on the market, the latest news, whatever's going on in the world of commercial real estate so that you can be a more educated and prepared commercial real estate investor. We've got a good show lined up for you all today. Excited to be diving into Deloitte's 2026 commercial real estate outlook. There's some interesting aspects of that if you don't read these reports, highly recommend you check them out. That I think you might find surprising for how commercial real estate investors and developers are viewing the outlook for 2026. We've got an article today from CNBC on how commercial real estate deals might be slowing, but there's a couple of sectors that are actually shining right now. Very important that you know what those sectors are so that you can be very intentional about where you are placing your capital, your time, your effort in today's market. Catching you guys up today, this afternoon, will be day 21 of 30 Deals, 30 Days. I can't believe we've already recorded 20 episodes in a row live almost every single day. I've had to catch up on a couple of them. If you haven't caught that series, we have a playlist under, I think it's just 30 Deals, 30 Days on my YouTube channel. Highly recommend you go and check that out. That's not something that we can release on the podcast simply because it is very visual, but I am underwriting a deal every single day, either that somebody who has joined the challenge submitted in the 30 Deals, 30 Days chat, or that a friend of mine has found. We had Chris in the studio here earlier. I'm going to have Logan Freeman in the office next week. Well, virtually, that is. And then, of course, finding some of our own deals. I did an autopsy of my first deal. I went back and walked you through that underwriting. I think that was day 14 maybe. So it's been really interesting. We've underwritten all different kinds of commercial real estate. Highly recommend that you guys go and check that out. And that's something that I pretty much do on a daily basis anyway, because we're always looking at deals. The more that you're underwriting, the more you're going through that process, the more you will get accustomed to how it works, and the faster you will be able to analyze these deals. I mean, I can pretty much within the first 5 minutes know whether or not a deal is going to be worth anything. All right, let's get to some of y'all's questions before we dive into Deloitte's outlook. Kimberly, how you doing? Kimberly's in the Brokers Mastermind. Good to see you here. She's saying, I think we will see more inventory. Oh, I forgot to tell you guys the question of the day. It's how do you think commercial real estate will perform in 2026? Kimberly's saying, I think we will see more inventory, and if interest rates hold, it looks good. I like that. The combination of higher inventory and better interest rates actually makes it substantially easier, not just on brokers, but also on investors. You have more options to choose from, and it becomes more of a buyer's market than a seller's market. So probably a better time to be buying in 26 than selling. That's for sure. Spyro is saying, morning, Tyler. Just wanted to say thanks for all the content recently, the 30 Deals, 30 Days especially. I'm a college student, and it has been really helpful to learn. Have to jump off soon for class. Spyro, thanks for being here, man. Hopefully you're kicking ass in class. Really glad to hear that you're enjoying the content. It's a lot of fun. Maybe we'll have to do another challenge like this at some point. Although I will say it's kind of exhausting, live streaming every day for 45 minutes to an hour. But I've really enjoyed it. I've never done that before. So, I thought it was kind of an interesting experiment to just try. Captain Kurt, what's going on, dude? Hope you're doing well. Saying, do you think commercial development will pick back up with interest rates trending down? I think it will. I think that commercial real estate development will certainly be more attractive for developers as interest rates come down. The problem that developers have had is that, basically September of 2022, interest rates started really going up. Construction costs started really going up. both material and labor. And rents kind of stayed the same, right? I mean, it was relatively flat growth. If anything, we saw negative rent growth in some markets. And so when you have all of that, most developers, their capital partners, and actually that's part of what we're going to be talking about with Deloitte. So you're very prescient, Kurt. Um, you know, capital doesn't want to put money into it. They don't want to take the risk. Now, what I will say is if you are the one guy that's building a 300-unit apartment complex today, you'll be the one person that's going through a brand new lease up in 2 years, right? There's not a lot of that development going on, but it's always really, really difficult to convince banks to give you good terms on that because usually the terms aren't great. To convince your capital partners to give you the equity because typically they're kind of wanting to hold their purse back. So I think that it will definitely pick up. Now, different aspects of commercial real estate development are still rolling. Like, flex space, ground up flex space, it's relatively cheap anyway. I still have clients that are full speed ahead on those developments. They haven't slowed down. Yes, construction costs have come up, but you have a market there that doesn't have enough supply. So if you have to raise your rents by 50 cents a square foot, it's kind of a marginal difference. So interesting to keep that in mind. KVG is saying, good morning. Glad you are here. KVG, I'm glad you are here. Thanks for jumping in, my friend. Kevin Bino is saying, hey, Tyler, truly appreciate the fact that you're able to keep up with office hours and still do 30 deals in 30 days. I appreciate that you appreciate that, Kevin. It's, I was looking at my schedule today because I'm actually headed to Mexico tomorrow for a wedding. So I've been cramming everything in. And we will still be live streaming from Mexico, by the way, for 30 deals, 30 days. I'm not going to let you guys down. And I was looking, I don't know that I have like a free 30 minutes today up until probably 7 p.m. And I've been at it since 7 this morning. So, I love it. I'm really happy to get to do what I do. I absolutely love my job, if you can call it that. I just get to nerd out on commercial real estate all day. KVG is saying, I see investors shifting back to that stance slightly after Meta earnings, along with some companies that have been laying off people. Could this be happening to companies that have these retail spaces, and they're just sizing down their properties to buy them at a better rate, leaving properties to never come back possibly? I understand people who got locked in these retail spots at bad deals or bad rates will benefit from rates dropping because they could refinance. And people who did not get a chance to buy retail spots will get better rates. If this is the case, why would every big corporation like H&M be leaving malls in bulk if they have the capital to withstand the storm? Well, KVG, I think that's a good question. I don't know that those brands have the capital to withstand the storm. I think that that's why you're seeing a lot of that. Also, most of those big retailers don't own their own commercial real estate. So we're kind of talking apples and oranges here. And I'm actually doing a video on this that will hopefully be releasing here in the next month or month and a half on why some brands buy their real estate and why others lease. Because both strategies work really well. But there's a pretty big difference in approach for those types of businesses. I'm 99% sure that H&M doesn't own like anything. So for them, it's more of a business issue, right? I mean, they're from Europe, and most of their clothing is manufactured in, I'm pretty sure, in Asia. So when you have tariffs go up like crazy on, foreign companies, foreign-made goods, companies like H&M that were already, not doing super well. I mean, they kind of had, passed their peak a few years ago. They're struggling, right? And so trying to figure out how they can be profitable with as many stores, with, competing with online, competing with all these other boutique retailers, that's probably what they're doing, man, is they're probably just pulling back, trying to figure out how to be very conscientious about their new approach, right? All right, Tommy's saying, how do we determine real estate taxes when modeling a deal? Real estate taxes tend to be one of the most expensive costs that can make or break our model, so how do we determine the value accurately? Super easy, Tommy. So you go to, whoever's levying your taxes. Like for me, it'd be Davidson County, and you would just type in Davidson County millage rate, and then you would multiply that by the purchase price. They make it super easy on you. Now, you'll have to go municipality by municipality to figure out when they are going to assess the new rate. Sometimes they only reassess every 4 years, despite what you pay for it. Sometimes they reassess it immediately. So that's what I would do. Is I would just go in and look up the millage rate. That is the rate at which you are taxed for property taxes. Kevin is saying, can't speak for the U.S. market, but the Caribbean construction cost has definitely shot up. The demand for residential is through the roof, but the rents are just unattainable. Exactly. Yeah, I mean, that's the crazy thing about it is that you have the demand. You have the demand, but you can't even remotely touch the supply because what we are able to supply today is too expensive for what the demand is. So how do we solve that? How do we create actually attainable and affordable housing in today's market? And that takes municipalities going through complete zoning changes. We need higher density. We need cottage style developments. We need more townhouses. We need more, lofts and apartments. We need more accessible and differentiated housing, right? Kevin, I can't say, what it's like in the Caribbean, but where I am in Nashville, you basically have a handful of choices. You can have a single family home, a townhouse, a condo. I mean, that's kind of it. And I would probably lump apartments under condos, right? But they call it the missing middle when it comes to commercial real estate zoning. There's this missing middle where it's like, look, back in the 60s, 70s, 80s, people used to build duplexes, triplexes, quadplexes all the time. In Kansas City, they have what they call the KC 6-shooter, which is it's a really cool, it looks like a house, but it has 6 apartments in it. It's 3 stories, 2 apartments per floor. I got that one from Logan. I don't know if it's officially called the Kansas City 6-shooter, but I think that's a really cool name, and I love the idea of what it is. And so we don't have that in most of our cities, and that is why we have an affordable housing crisis. Because if you have to build a single-family home on a 1-acre lot, because that's all it's zoned for, I can tell you, on a 1-acre lot, you could easily build 10, 15, 20 units, more, depending on how you wanted to actually design it. So it's really tough to figure it out privately. You have to get into it with the public market. All right, let's dive into this 2026 commercial real estate outlook from Deloitte, because I think you guys are going to really enjoy some of what they are talking about in here. So they're saying macroeconomic volatility and policy uncertainty may put the commercial real estate industry recovery on pause, but not for good. Let's see. Trade and regulatory uncertainties have complicated decision-making, prompting some leaders in CRE to rethink their approach. Opportunities for growth likely exist for those who understand the industry's geographic, asset, and macro-level nuances. You got to also remain agile and forward-thinking. I think that's the biggest thing is, how do you maintain your creative thinking as you are going through all of this, all right? So if we are navigating a pause in recovery, their survey respondents are saying that they expect their revenues and expenses to change for the coming 12 to 18 months. So slight pullback in optimism from 2025. 83% of respondents expect their revenues to improve by the end of the year, compared with 88% last year. So last year, people were more positive about revenues being able to increase, but we're talking 5%. I mean, that could just be a statistical anomaly, to be fair. It depends on if they just got more people to actually take the survey this year. 68% anticipate higher expenses this year. And that's not difficult to see. I mean, in Nashville, we just underwent a massive property tax increase. We're only starting to see more and more extreme weather events that are causing all sorts of issues, not only on the coast anymore. I mean, look at what happened in Asheville, right? I mean, you saw this hurricane come inland that caused so much rain and destruction on an inland city that now you have insurance companies that are looking at this going, okay, well, these extreme weather events are no longer just impacting the coastal cities. So maybe we're not just raising all of our insurance rates on the coast. It's got to be across the whole damn country, right? Which, maybe makes it easier to invest on the coast, but it's going to make insurance costs go up for everybody. And at a certain point, you've got to sit there and go, is it worth insuring my property? Now, if you don't have a lender, you don't have to do that. If you are going through the traditional bank, they're going to require you to have insurance. But there are alternatives out there. You could self-insure. You could join these like different kinds of groups. I've got one buddy who's actually going out. He's not insuring his whole property through one group. He's insuring his roof. He's insuring the structural components of the building. He's insuring the interiors. He's insuring the exteriors. He's breaking it all up into different companies so that he can, try and get better rates, which makes a lot of sense. So despite a slight dip, sentiments from 2026 survey respondents remains optimistic. Slight dip from 2025, but when you compare this to 22, aside from revenue expectations, when you compare it to 22, 23, and 24, outlook is substantially better. It was pretty abysmal in 23 and 24. I felt pretty good going into 25. As the year has gone on, I've kind of gotten a little, from a macro level, we're still buying commercial real estate deals. We're still finding tons of opportunities. That's the interesting thing about it. But, hey, interest rates are different. We have to underwrite these deals a little bit differently. Now, this figure I thought was pretty interesting. If you're watching on YouTube, you can tell this is lending markets and interest rates were of top concern surveyed from the surveyed commercial real estate leaders for 2026. This is comparing a ranking, a global ranking of what was what they thought posed the greatest risk of negative impacts to the company's financial performance in the next 12 to 18 months. Now, look at number 1 in 2025. That was elevated interest rates went down to number 2 in 2026. But look at number 6 in 25, which became number 1, capital availability. People felt pretty secure about being able to find money. You've heard people talking about this dry powder that has been sitting on the sidelines forever, right? We're all sick of hearing the term dry powder. That's what that is referencing right there. Last year, everybody felt like there was a lot of dry powder on the sidelines. Now, that's the number one risk that these commercial real estate investors are seeing as for a negative impact to their company's financial performance, meaning they feel like they're not going to be able to raise capital or qualify for bank loans. Of course, cost of capital came up a little bit. Currency volatility, which was not a thing last year, is now number 4. We have changes in tax policies, which actually came down from 3. So, not as big. Cyber risk is down. Regional political instability is down. That's probably because we've, despite the political instability that is 100% going on, no matter which side you are on, you cannot argue with that. I think that we all kind of at least have an idea of what the chaos is going to be, right? It's like my track coach when I was in middle school. He called track meets organized chaos. That's kind of what I feel like politics in the U.S. is right now. But that's of concern, right? You don't know. If another tariff gets instituted tomorrow, how that could impact a specific sector of commercial real estate, because it will, right? We were just talking about H&M and their closures. I wouldn't be surprised if tariffs had an impact on that, which is now causing them to close stores, which will impact landlords, right? Employee retention has gone up from number 12 in 2025 to number 8. That's one of the bigger jumps that is not in the top 5. So, there was a time where everybody kind of felt like, oh, there are too many people in commercial real estate. We don't need to make any hires. And now people are starting to get worried about retaining good talent. So interesting to see. Those are some of the pieces that I saw that stood out on that graph that I thought were pretty interesting that I wanted to share with you guys. Let's see what else we've got going on here. Nearly 75% of respondents expect to increase their real estate investment, mostly to hedge inflation and diversify portfolios. So that's saying 3 out of 4 individuals expect to buy more commercial real estate because they expect the U.S. dollar to be worth less, which means you need to own hard assets, right? When we get into economic uncertainty, people start to buy gold, right? It's the exact same reason that they're buying a hard asset. That's the exact same reason why a lot of investors buy commercial real estate. It is a hard, tangible asset that you buy it for $100,000 today, even if the dollar gets devalued or inflation kicks in, whatever, which is really the dollar getting devalued. Then, that building's going to just go up to being worth $200,000 without you having to do anything, right? But your loan is still going to be at $75,000. So, it starts to really make sense if you're hedging against potential inflation increases. All right, how does your company expect to change its level of investment in real estate? So 16% said increase significantly. I would fall under the increase slightly, which is 58% of the vote. We plan on acquiring another probably 3 to 4 properties in the next 12 to 18 months. We used to, it might end up being 2 to 3. I mean, we used to acquire 4 or 5 every single year. And it got to a point where it's like, you know what? I don't think now's the time to be getting aggressive on deals. We really need to take our time, make sure that we're getting into the right deals, and approach it from there. So we're still looking at as many deals as we were before. We're just not moving. We're not excited about a lot of them. What is the greatest reason why your company is looking to increase? 34% said hedge against potential inflation. That's pretty wild. 26% said diversification with other held financial asset types. So that means maybe you're investing in stocks, bonds, or even multifamily, and you want to go buy industrial, right? You're just diversifying your portfolio. 15% said returns are more stable than other financial asset types. 13% said potential tax benefits. The United States remains a top investment market for 2026, but investors are also looking elsewhere. I think that that's pretty interesting. It talks a little bit about the Asia Pacific. Top targets for survey respondents include India, Germany, the United Kingdom, and Singapore. Now, one thing that I do want to mention with this report that I think is important to keep in context for us, right? Because we are a different breed of commercial real estate investor. Most of us are mom and pops. Maybe we've got some teams of 4 to 5 to 10. We are not your private equity firms. We're not REITs. I mean, a lot of who they are surveying for this are some of the biggest companies in the world, right? And so I doubt that, my neighbor John, who buys buildings, is going to look at Germany just because of what's going on in the United States, right? But it is interesting to see kind of how people are thinking about it from a macro, level at that point, right? 16% of respondents still preferred the United States. Let's look at this. Top CRE markets. India was 13%. I mean, India, substantially higher than investing in Canada, Mexico, Japan, UK, Singapore, Germany. That's kind of interesting, right? I mean, I wonder what's going on in India that would cause that. Let's see. Digital economy properties retake the top spot while offices steadily gain traction. So they're saying digital economy properties. I'm actually not even remotely aware of what a digital economy. Okay, data centers. What? Why not just call them data? Why would you call them digital economy? Sometimes people just come up with weird names for things. Okay, so digital economy apparently means data centers. So let's just call that data centers. Followed by logistics and warehousing, followed by industrial and manufacturing, then multifamily, then office. Wait, they're saying office and multifamily are above retail. That's amazing. Single family rentals are above retail. I couldn't disagree more. Now, they're probably talking about retail at scale, which is not the type of retail that I do. I'm not going to go and buy, the Green Hills Mall. I think that that's probably not a good investment. But, when we're talking about neighborhood strip centers, I would put a 3-tenant strip center over multifamily every day. We're able to get better returns. I've got clients that are getting better returns on all of their investments when they do that. So I'm sure, of course, you have to keep in mind what scale that we are getting to as we're talking about this. Self-storage is towards the bottom. See, that also doesn't make any sense to me because self-storage, we're doing a deal right now that is going to net us $30,000 a month, net $30,000 a month from 350 units. So, I'm sure, again, we're talking about at scale. We're talking about thousands of units here. Maybe at that point, it starts to, it starts to get a little funky. So, who knows? All right, let's move on. You guys can always dive into that to yourselves. This one is from CNBC, talking about how commercial real estate deals are slowing, but these two beleaguered sectors are shining. So let's see what they're talking about. Commercial real estate deal making is having a rough 2025. I also let's caveat that with our sales are barely down year over year, so it's not rough. I'm sure if you're a CBRE and you deal with mostly institutional capital buyers and massive transactions, yeah, that's probably taking a pretty big hit. But boutique commercial real estate investments have been relatively steady. They're not as great as they were. Like 2022 was substantially better, like by far. But it's not like it was. Let's see. The overall value of deals has grown just 5% from last year as of the third quarter. Oh, no. We've only had a 5% year over year increase. Look, if you consistently got 5% increases per year, after 10 years, your property's value is going to double in 10 years without you having to actually do anything. So I would be totally fine with getting 5% year over year. In fact, we underwrite 3%. So that's kind of funny. So keep all of that in mind. Trends in September reveal several themes: flight to quality, economic uncertainty hitting the hotel sector hard, and a growing interest in office and retail. Interesting, because we were just talking about how bad retail is apparently for all of these other commercial real estate investors. Let's see. Flight to quality can be seen in the average dollar size of sales, up to $12.7 million compared with the average of $11.2 million over the 2 years prior. That is a pretty substantial jump. We're talking about a 10% increase in the average sales price. Let's see. We've had a lot of volume of growth recovery after the first Fed rate hikes in 22, 23. 2024 was a pretty good year, said Kevin Fagan, head of CRE Capital Markets Research at Moody's. We saw a significant volume expansion. Fagan noted that there is much more certainty among investors in higher quality properties. I think that makes a lot of sense. One glaring weakness is the hotel sector, which is always great to hear when you're about to deliver a hotel, right? With deal value down 30% in September compared with the same month in 2024. That was the only asset class to post a significant decline last month, likely due to a drop in international and business travel. Yeah, let's be fair. The government's been shut down, air traffic control has been a mess, all that stuff. Fortunately, Nashville, this is obviously a personal anecdote and an aside, but Nashville has so many people that just drive in as well that it is not fully dependent on international. Now, I will say we get a lot of Canadian and European tourists in Nashville, and so that has hurt. But we go down to Broadway for Predators games, and it's still packed. So tourism is still alive and well in Nashville. While hospitality took a hit, office notched a win. In September, Apple spent $365 million on an office property portfolio in Sunnyvale, California. I wonder how much of a discount that was from what it probably would have gone for 10 years ago. Maybe even 5. NVIDIA spent $83 million on a single office building in Santa Clara. MetLife got a roughly 39% discount deal on an office property in Newport Beach. They're all buying office buildings again. Remember, everybody said, office is dead. Nobody's ever going to go back. Now you're having all these companies tell their workers they're coming back into the office. The total returns are good. You're buying at far less than replacement cost. So you put it all together, and it's a very resilient, essential real estate need where we can make strong risk-adjusted returns. I agree. I like office. For the right opportunity, it makes a whole lot of sense for you to be jumping in on that type of asset class, right? So let's see here. We got a couple more comments. KVG, that's a lot, man. I'm not going to be able to get to that today. If you can take those comments and drop them in as like a permanent comment underneath, I'll be sure to get back with you, my friend. Em is saying, good morning. Don't forget to like. Yeah, come on, guys. If you're enjoying it, don't forget to like and subscribe. Share it with a friend. Send to them and say, look, commercial real estate is going to be fine in 2026. John is saying, how much does this program cost? I've been wholesaling for a year and do $100K a month with me and one other closer. John, I will say this. It's less than $1 million to join my mastermind. So if you're interested, give us a call. I don't share the pricing anymore. I mean, it's not a secret. Like we tell it to you when we get on the call. I made a big mistake earlier this year where I said what the price was back in like February or March, and then we had a price increase in May. And I had some dude legitimately get so upset with me that we raised our prices that he ended up paying for it and then called me a week later and backed out. I was like, okay, well, like lesson learned. Unfortunately, when I put something out in the podcast, it's some people are just going to take that as the end all be all. We raise our prices when we increase our offering. So it is what it is. Kevin is saying, Tyler, how is that hotel development you've been working on coming along? Last I heard, you were close to opening. We are on the 1 inch line. I wouldn't even say the 1 yard line at this point. I mean, all the rooms are ready. The main house still has a couple of items, really just the lighting, like the fixtures in the space. We're being very picky about those. So, unfortunately, I can't get my fire inspection until that is all fully done. But we want to make sure that we do it right. So that's the biggest thing. So we're close, man. I've got my staff partially hired. We're really excited for it. I mean, it looks absolutely gorgeous. Bryson is saying, what's your biggest challenge right now when it comes to commercial real estate? That's a good question, Brayson. I mean, I would say like this to me is always my challenge. It's just raising equity, raising capital. Like, and it's not because like we have a problem doing it. It's just that I don't like doing it. I mean, I've got some great investors. We raised a lot of capital for our deals. I mean, we just closed out a deal in August where we raised about $4.5 million in equity from a lot of you guys here on YouTube and the podcast, actually. So if you guys ever want to invest with me, that door is open. I don't know, just going through it, like it's easy for me to find deals. It's easy for me to underwrite deals. It's easy for me to put together the narrative. Banks can be tough too, just because, we're more creative. So like convincing a bank that they should think a little bit outside of the box can be interesting, but it's just capital. And it's not even necessarily convincing investors to go along with the journey because they've all signed up to invest with me because of the way that we invest. It's, hitting everybody at the right time. Somebody will say, hey, I'll commit $100,000 or $50,000 or $500,000. And then, their kid gets in a car wreck and they've got to buy a car, right? Or something like that, right? I mean, stuff just happens. Life happens. So it's all that kind of stuff. John is saying, I'll call you guys. No worries. I don't get upset about the pricing. Well, John, I appreciate that, man. If you book a call this week, by the way, I am the one taking those calls. So you are more than welcome to do that. I will be the one that is handling the call. Jam is saying permits are so bittersweet in there. Keeps things safe, but can be a pain. Yeah, I mean, I get it. I get all the inspections. We want to make sure that it's all done right. But damn, is it a process sometimes, and just making sure you get all of the little details right. So Brayson is saying, so you need to get more qualified investors. Is that right? I mean, I've got several thousand people on our list, so we actually end up closing out our qualified investors pretty quickly. I mean, look, we're always looking to add qualified investors to our list. I think anybody that wants to, anybody that does what we do, right? You guys are probably always looking for new investors because, you just never know, especially if you're doing 3 to 4 deals a year, you're going to tap out some of your investors. It's important to continually be adding to that, right? So, yeah, I mean, I would say, yeah, that's something that we're always going to do. Kevin, oh, cool. Do you put staff expenses in your underwriting too? Don't think we ever touched on that. No, I don't. I mean, I actually have a pretty light staff. I mean, right now it's me. I got to a point where I had 11 employees in the firm, and I realized we weren't doing any better with that, like at all. And so, yeah, I mean, of course, am I having to work on the deals a bit more? Sure. But we can also outsource some of that stuff. We can send it to contractors. So like, yes, in a way, it's in the underwriting, right? Like instead of having, my team work more on design and selections, we just pay, our architecture team to do that instead. I used to really want to be hands-on with everything. And now, I just come up with all of the ideas for the direction, and then they handle everything. So Conan is saying, moving forward in your career, do you plan on using most, if not all, of your own capital in terms of financing? Absolutely not. I would prefer to never use any of my own capital. I mean, we syndicate, right? So I'm raising capital from investors going out and doing these deals. Now, I place the minimum investment alongside. So if our minimum investment in a deal is $50,000 or $100,000, then yeah, I mean, I'm putting $50,000 or $100,000 into it. I will buy one-off buildings here and there. This year, I've been doing this for 7 years now. This is the first year that I've ever bought properties by myself. I've always had partners. That doesn't necessarily mean that I syndicated, but I've always had partners. There were strategic reasons for that. I mean, I'd rather have a slice of a watermelon than a whole grape. And being able to go out with other partners that had a different reach to different investors or different experiences that made the lender, give us better terms on our notes was so worth it. So to me, yeah, I mean, I think at some point, I'll want to look, if I had $100 million in cash, I would never have a partner again, right? But I'm working on this just like you guys are. KVG saying, I have no idea how to pin a comment. So KVG, once this video is done, there will be regular comments under the YouTube video, and that's where you'll be able to do that. He's saying, so the question in short terms is, won't the decline in the mall ecosystem worsen the U.S. economy? So does that mean malls will never leave, or it could be like the Blockbuster stores eventually? No, I mean, I don't think that that's going to I don't think that malls alone could worsen the U.S. economy. I think that the reason that malls are dying is because we have alternative economic pathways for people to buy their goods, find their goods, whatever. And malls don't function in the way that people shop anymore, right? People are buying online a lot. So, it's just, to me, like, malls deserve to die. I think that they do. And we can have a long discussion about that. They were built wrong from the very beginning. They were not designed right whatsoever. I mean, whoever came up with the idea for the suburban mall, should forever live, or maybe they're dead by now, in infamy. Horrific plan, because you have a sea of parking lot surrounding a giant building. So it's not pedestrian friendly. It's not designed well, and it's all retail. So it's a destination. Like, you have to go out of your way to get to this thing. If malls were designed the exact same way, but with parking garages, out parcels, and multifamily apartments above, not a single one would be struggling right now. So, food for thought. Kevin is saying, oh, no, I meant hotel staff. Oh, yeah, absolutely. I mean, when you're underwriting a hotel, you've got to take into account all of your operating expenses when you're doing that. Kimberly's saying, Tyler, are you ready to talk about the triple net offering that I saw? It's still grayed out, but I saw it there in the portal. Kimberly, I'm not sure which one you're talking about, but I will text you as soon as I get off here, and we can talk about it. Conan is saying, did you pick partners depending on the project type, and have you ever gone to institutional sources for financing? Yes, I was very specific on the partners that I picked. Because, like, for example, on my hotel deal, I never did a hotel. I wanted everybody to feel really good about me doing a hotel. And I went and grabbed a partner that had 30 years of experience in the hotel world, right? So very intentional there. As far as institutional sources for financing, like, yes, we have gotten bank loans from pretty big banks. If you're saying more on the equity side, absolutely not. I have no interest in working for somebody else. And that's pretty much what it becomes if another group is going to come in and write the whole check. Brayson is saying, so if you could wave a magic wand and have that building equity problem solved, what would that look like? Is it always more business relationships, private investors, better deals with banks? No, I mean, it's just, equity problem solved. I don't know. I mean, to me, what it would look like is I just send out an email to all my investors. Nobody has to hop on a phone call with me, and they give me the money. Jim is saying it's not too late to do that to malls. Yeah, I agree. It is not too late at all. In fact, there are developers that are doing that. Look up One Bellevue Place in Nashville. That is headed in the right direction of what it should be. In my opinion, not dense enough, needs parking garages, needs more multifamily units. But I completely agree. I mean, I think, look, if you take, these shopping malls, I mean, let me just pull one up so you guys can actually see Cool Springs Galleria. This one is an absolute mess when it comes to how big the parking lot is. Now, let's turn it on to satellite. So this is down in Franklin Brentwood area. Look at that. I mean, sea of parking lot. It's just absolutely horrific. Now, this is like 2 or 3 stories maybe. Imagine if this was 5 stories and it had a hotel, it had, maybe a convention center, it had apartments or condos. You took, maybe a portion right here, turned this into a massive parking deck and built, more above it, and then started doing little out parcels all around it. Adding some green space and walkability and parks. Then it's not just a mall where you just go shop for things. It's actually a community that you want to live, work, and play in, right? I mean, as it sits right now, of course malls are doing bad. I mean, it's just like these parking spots are never used. It's just a waste of space. So, yeah, I am very opinionated on the shopping mall. KVG saying, but what about all these tariffs that are being forced on most companies because they don't have products made in the USA? Does that not affect the P&L of companies who upcharge in person? Yeah, I mean, that's what I said earlier, right? I mean, the tariffs are impacting these companies' P&Ls, and that's why they're having to shut down some stores. So wouldn't all of these other amenities raise the lease price of people who want a storefront? Yeah, it definitely could. But you would now have 1,000 or 2,000 people that live on site. I mean, look at pretty much anywhere that's walkable or that has been converted walkable. All the prices have gone up, but it's sustainable because you now have more people that can actually afford or that actually are there and they're spending more money there. So yeah, I mean, the prices, like that's a good thing. You want to be able to raise the prices, right? I mean, right now they have stores closing because there's not enough demand from shoppers there. But if you converted it into something that's live, work, play, you would never have that issue because you would have a built-in clientele that could grab breakfast there, grab lunch there, have an office there, whatever. Kevin is saying, my last comment here. My birthday is November 19th, and underwriting my Barbados deal on day 29 would be an awesome birthday gift. We'll send those details so you can have a look. Kevin, we will definitely take a look at it, I promise, especially since it's your birthday. But I can't make any guarantees because I have never underwritten a deal with Barbados, and I would have no idea what I'm trying to wrap my mind around, but we will see if we can figure it out. Maybe that would be like half the fun. KVG, you don't need to apologize, man. We were talking about tariffs earlier with H&M, right? I mean, that's probably one of the reasons as to why H&M is struggling, right? Because they're based in Europe. They're getting their stuff manufactured in Asia. There's tariffs all over the place, man. Jim is saying all those things require a ton of speculative money and demand. No, they don't. Not at all. Right? Like I said, I'm very opinionated on malls. So you guys can attack my approach however much you want. I've got the response. So look, here's the thing. It's not speculative whatsoever. If I go out and I find a multifamily developer with affordable housing credits or something like that, like we can build a whole bunch of multifamily. Now, part of that is going to be speculative. The other piece, though, is there is a massive amount of demand for affordable housing. There's a massive amount of demand for apartments and condo living. And think about how cool of a community that could be if you get to go live where, all of these amenities are, right? Everybody would want to be there, right? And so the multifamily part, sure, I'll give you that. Maybe that's a little bit speculative. But after that, going out, like you build the parking garage because of the multifamily. Now you can start eliminating some of the parking that's on site. So go out to Chick-fil-A and see if they want to take an out parcel. You can sign these leases ahead of time and do a build to suit instead of having to, just go and build something and then hope they come. You can get really, you can do pre-leasing, you can do all sorts of things that make this not very speculative. People just don't do it because it requires work. And most people that are investing in shopping centers today, malls today, don't really want to do that. They kind of want to just collect the cash flow. You know what I mean? KVG saying, I love your opinions on malls. This has been the biggest confusing question I've had for the past 2 years. So less malls, more strips. Yeah, I mean, I think if you look at like what's going on in Florida and some of these other areas, like you've got these really cool like indoor outdoor malls that have green space, parking garages, office, hotel, convention center, apartments, whatever. I think really the point that I'm making, if I wanted to condense it all down, is that they're single use today and they need to be mixed use. All right. So there we have it for this week's Office Hours. I've got to get to the hotel and do a site tour. Appreciate you guys for joining us. Join me every week, Tuesday, 8:30 a.m. Central Standard Time, to learn more about what's going on in the market in commercial real estate. You can jump in and ask your questions. Thank you all for everybody who jumped in today. This was a great discussion. I really appreciate you all for doing that, and we will see y'all next time. This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more.